we've got a great topic today. And I think this topic can help you gain an understanding on what's going on, once a loan is, a borrower starts working on their loan, whether it's the pre-approval or it's the actual binding contract and moving toward closing. So we're going to talk about what I call the 4 underwriting steps. And if we need to cover some of this next week, we can. I don't want to skip any part of it because all of it's important. So the first one I'm going to mention, the first underwriting step, is what we call Automated Underwriting, AUS, Automated Underwriting System. And there are 3 different automated underwriting systems. Fannie Mae has one. It's called Desktop Underwriter. Freddie Mac has one, and it's called Loan Prospector. And USDA has their own, and it's called GUS, G-U-S, standing for Guaranteed Underwriting System. So those are the 3 underwriting systems. We are going to spend most of our time discussing Fannie Mae and Freddie Mac, Desktop Underwriter and Loan Prospector. Now here's what happens. In most cases, you've heard the phrase, I heard this phrase all the way back to before most of you were even born, when we were working on computers, and they said garbage in, garbage out, garbage in, garbage out. And the way that automated underwriting works is you can put anything in. So it's not uncommon when you get how many of you have had pre-qualifications or pre-approvals that turned out not to get approved? I see some of you nodding your heads. You've had that happen. Well, that's because either the lender did not verify the information before they put it into automated underwriting, or the borrower just gave them information that wasn't accurate. And here's what happens most often. And I'm going to give you a live example. I've got a lady who works for a mortgage company. If I told you the name of the mortgage company, most of you in the room would know exactly who it is. She's an employee of this particular company. And so they give her a break. They give their employees a little bit of a break if they in fact use their company. So why would I be talking to her? I don't work for that company. Well, she was encouraged to call me because she had questions. I'm thinking, okay. So when I'm speaking to her and her husband, this is just over the weekend, what I find out is that here's what happens. And I know this happens a lot, especially with online lenders. They told her, all you have to do is go online. Click on this button, it'll take you to the application. So she did. Her and her husband went on the line, filled out the application. Then the application came back and said, give us the following documents. And they uploaded the following documents. And a few minutes later, it came back and said, you're approved for $388,000. They never spoke to a soul. They had questions. And this is what the company said. You don't have to worry about that. Now you can go out and find a home, and when you find a home, call us, we can answer your questions. I'm like, seriously? I am so glad to hear people actually do that, because there are some people who really do want to talk to them. So I get on the phone with them, and I start going through their entire situation before I ever let them get to an application. We walk through the whole thing. Part of the reason for doing that is because I want to know as much as I can about their situation so that I know how to advise them on what they should do. Garbage in, garbage out. Does the borrower put in all the correct information? How many people in the room right now think that a borrower, you, filling out an application, are going to put in exactly what's supposed to be in there?
They don't know the right answer.
They don't even know. Thank you, Casey. They don't know the right answer. Even if they did, they may not put it in the right place. One loan I was looking at over the weekend, They didn't put in their monthly income, they put in their biweekly income. Well, they made double that amount. So for that reason, garbage in, garbage out. The way that I look at AUS is that let's get everything in that is as accurate as possible. Now, why do we use AUS? Why do we use automated underwriting? Because back in the late 90s, Fannie Mae and Freddie Mac, when they came out with it, they said, we are going to tell you, we're going to tell you whether or not we would take this loan, and we get what's called an accept eligible, or we get a refer ineligible, or we get an accept ineligible. Any number of different responses. The one every lender looks for is approve eligible. But if we don't put in the right information, we may get an approve eligible only to find out that they can't get a loan. So it's not about getting the approve eligible, it's about making absolutely sure that the information we put in is accurate. Now, those of you who get pre-approvals from me, one of the things that you find is that I actually put in there, in one of the stipulations, what the maximum property taxes, homeowners insurance, and HOA can be. You've seen that on some of my pre-approvals. Why? Because the number that I got the approve eligible on was dictated by the information I put in the system. How many of you would trust the database that exists out in some cloud someplace that they're going to put in the right taxes, the right HOA, and the right homeowners insurance? Nobody. But yet, that's the kind of input that's getting stuck in there. And then they say, well, I received my pre-approval letter, here it is, from ABC Mortgage, and the information's not accurate. So the first underwriting is automated underwriting. But automated underwriting is only as good as the data that's put in. Now let's make an assumption that all the data is put in properly, you receive your approve eligible. The other beautiful thing about automated underwriting is it tells us as lenders what documentation we're going to have in order to give this loan a final approval. And what you're going to find is that in many, like if you're a W-2 employee and you're not 100% commission or anything of that nature, we're probably not going to need tax returns. If you put in self-employed, it's going to come up and say you've got to have 2 years tax returns. If you read the fine print, it's actually going to come out and say, if you can prove that the business has been around for 5 years in that name, then we may only need 1 year tax returns. So AUS is going to come back and tell the mortgage company, the loan officer, what documentation is or is not needed. So the first part of underwriting is AUS. Now, when can you run AUS? I don't give a pre-approval out unless I run AUS. That's how I find out I'm making sure the information's in there, we make sure it's accurate. Once I get that approve eligible, I can issue your pre-approval. Now, you and your customer know it's good. Now, I was very bold about 5 minutes ago, and I just told the customer I was talking to, one of Bob's clients, I said, if I give you a pre-approval, any lender in this country can do your loan. Because I know I am going to make absolutely sure that the information in the system is accurate. Once I know that, we all underwrite in the country to Fannie Mae, Freddie Mac guidelines. So if I verify everything, that loan can be done by anybody. I still want it to come to me, but anybody can do the loan. All right. Now, that's not the case with every lender. Why? Garbage in, garbage out. If there's nobody to talk to, like this one client I was mentioning too, how do you know the information's accurate? If the lender is not looking up taxes, if the lender is not taking the time to see if there's an HOA, the information may not be accurate and you get a pre-approval that then in fact doesn't hold up. So let's make the assumption everything's good. How many of you have heard of appraisal waivers? What lenders call, Good, just about everybody. Lenders call them property inspection waiver. Same thing, you can call it an appraisal waiver. The appraisal waiver comes from the AUS findings. The lender doesn't give an appraisal waiver. The lender is the conduit to say you're going to get an appraisal waiver. We get that information from the AUS findings. So sometimes I'll get a phone call and it says, well, Greg, is there any way that you could get us an appraisal waiver on this? I say, well, I don't know, maybe. And they say, well, I see lenders doing it more and more. The lender doesn't do it. AUS, Automated Underwriting, gives us the findings, and in the findings it'll say PIW, eligible or ineligible. If it says PIW eligible, that means I don't need an appraisal. Neither does any other lender. Yes, Lanier?
So is that based more on the property or on the buyer?
What a great question. Is PIW appraisal waiver based more on the property, based more on the buyer? And it's both. The buyer, first of all, it's generally speaking a higher down payment. 20, a minimum 20. I haven't had a property inspection waiver on a less than 20% purchase. I have not. I'm not saying there isn't one out there. I haven't had it happen. Most of the time it's 25, 30, 35% down or something of that nature. So that's the first thing is down payment. Next is credit score. I've never had a PIW on a score below 700. I've heard that they've had some. I haven't seen it. I guess if you put 50% down and you've got a 688 credit score, you might get a property inspection waiver, but I haven't personally seen it. So first is a higher credit score, typically 20% down, 25% down, 30% down, you may get it. Now, property. What happens with the property is Fannie Mae and Freddie Mac have got this huge database sitting out there. And I don't know if any of you had a chance to read Friday's Finest, but this last Friday, I put the information in there about how Fannie Mae and Freddie Mac build their database. And that database is based on every lender. When we get an appraisal, we have to enter the conventional, we have to enter all that information into the Fannie Mae Freddie Mac database. It's called UCDP. That data goes into the system. They run the new appraisal that comes in on a property, Lanier, we run it through their system, and it looks at all this data that it has from all the thousands of appraisals that have been there, and they look at the same comparables and say, oh, the adjustments look fine, this looks good, this doesn't look good. As long as they get a relatively low score, they're going to go ahead and say, okay, fine, we'll give you an appraisal waiver.
Is that information public anywhere?
No. Nope. Nope. All right, so AUS is a fantastic tool for the lender as long as the information we start out with is accurate. The second part of it is the information comes back, tells us what documentation we're going to need that we're going to have to get from the borrower. And the third thing is AUS is run when you get a new contract. Casey turned in a new contract, and we're in the midst of we've already got the AUS done, the pre-approval done. Now we're just going to take that contract information, put it in there, and then Brandy will rerun AUS, or my wife will rerun AUS today before we send out the disclosures. Pretty simple. And just to make sure all the findings are the same and nothing's changed, and put in the actual address of the property and the sales price, the down payment, we got everything in. So once that's in there and we get another approved eligible, the loan now can move forward. Now this is where, okay, we're not going to get through all four. We're going to get through two today, underwriting things. First of all is AUS. Second is what I call the initial underwrite. Now, lenders do this differently. Not every lender does it the same. I will tell you how we do it and how my previous company did it because I like it this way. What happens, we have minimum documentation requirements that have to come from the loan officer and go into operations. We have to have enough information. When my operations team gets that loan, they have to have enough information that they could make an initial credit decision. They've got to have pay stubs. We have to have some information on assets. We've got to have some W-2s. We've got to tax returns if it's needed. We have to have enough information so that a live person can review the AUS findings against the actual documentation that's come in to make an initial credit decision. That's how we do it. That's why Casey had a binding contract come in last week on Monday or Tuesday, and on Thursday, Brandy already submitted it to underwriting. Went into underwriting within 2 days. And that was because that particular borrower, his name's Matthew, this guy is on top of everything. He got it in right away, everything was there. Brandy just had to get the loan, reviewed it, sent it right into underwriting. We'll probably get an underwriting decision on it, initial underwriting decision on it today. I like that because we're way ahead of the game. That's what we want to have. We want to be as far ahead of the game as you can. The initial underwriting also does something else. It tells us, did I make a mistake someplace as the loan officer? Did I miss something? God forbid, my wife doesn't miss much of anything, or Brandy. Now, fortunately, because I have the two of them, we don't miss things. But if a loan officer does miss things, and that happens from time to time, more often than we care to if they don't have good people behind them, I cheat. I've got Michelle and Brandy, make sure that it's done right. And every once in a while, I get these calls from my wife, and she'll say, "What in the world were you thinking?" I said, "What do you mean?" And she says, "Where did you get this from?" And I go look in the loan. I say, "Here." She says, "Well, it would help if you would tell us this." So somebody behind us that makes sure the information's right, then Brandy can submit it to underwriting, and we get an initial underwriting finding. Now, from that initial underwriting finding, underwriter's going to look and say, "Hey, I'm going to need the following things that you may not have thought of, but I want this." Now, underwriting is not there to pick it apart. I know sometimes you think that. That's not what they do. They just want to make sure the loan is going to be saleable to Fannie Mae, Freddie Mac, HUD, VA, or USDA. That's all they're really there to do. So sometimes they'll look at the documents that are supplied and they'll say, "We're going to need something else." They might say, "Can you get us a letter of explanation?" Anybody know what the number one fraud issue is with home purchases today? Number one fraud issue. What's that?
Money in the bank?
Not money in the bank.
Income?
What's that?
Income?
Nope, not income. What's that?
Employment?
Number one fraud issue going on in the industry right now is occupancy. People lie. They're going to buy the house to live in. They're going to buy the house as a second home. They're going to buy the house as an investor. What are they going to do? So what happens if you're buying a house and you're selling and you own a home right now and it's in Midtown Atlanta and you want to buy out in Johns Creek and the house in Midtown is worth $400,000, the one in Johns Creek is worth $425,000, somebody's probably going to ask the question, because you're not going to sell the house in Midtown yet because you don't have to. What's the typical question? Why are you moving? So underwriting's probably going to come back to us and say, could you provide us with a letter of explanation as to why you're buying basically the same home, but you're only going to be a few miles away? What's the deal? So underwriting might come back and ask some questions. Sometimes they'll look at the credit and they'll say, can you give me an explanation for this derogatory remark over here? Whatever it happens to be, they'll ask for some things. The more complete that me, Michelle, and Brandy are on the front end, the fewer things we're going to need from the borrower. And that's when, yes?
Is there a rule that they have to, if they own a home and purchasing another one, that other home has to be within or 100-mile radius outside of their primary residence?
Okay, if they're buying a home, that they own a home now, is there a distance that they have to be? Is that what you're saying?
Right.
Yes and no. You can't get another primary residence next to the one that you're buying. It's very difficult to get another primary residence in the same metropolitan area unless you can provide an explanation as to why you're doing it. Now, one of the greatest explanations is, My home that I live in is under contract right now, or it's being listed. But I don't want to sell it until I close on this one because I don't want to move. They want to wait. And if they're financially prepared to do that, they can. Where we get into trouble, and you all, if you haven't, you will run across people that are going to tell you, well, hey, the home is in my wife's name. I'm going to buy this one over here. And this one over here is going to be this. I own the home right. My wife owns the home right now. It's worth $550,000, and I'm going to buy this one in Buford, and it's $320,000, and that's going to be my primary residence. First question: why are you buying a home for $320,000 in Buford if you live in a home for $550,000 in Johns Creek? Well, that's my wife's home. It's in her name. I understand. Why would you want to go live in Buford in a home that's $200,000 less and not live with your wife?
We don't like each other.
What's that? We don't like each other.
She told me I should.
So that, in a case like that, you're not getting another primary residence. You can't even do that as a second home. That's an investment property. Those are the kind of things lenders have to ask the question on. And if I don't ask the question, my underwriters will.
With the letter of explanation, if your explanation was, well, we're not selling the property yet because we don't feel comfortable selling our property until we've purchased our next property, given the market, are they accepting those types of explanations?
Maybe. There has to be a compelling reason for that downgrade. If you're my age and you do that, piece of cake, because I'm downgrading, because I'm old. If you're the age of Worrell and you write that up, Worrell, I'm sorry, it ain't happening, buddy. So there's got to be a compelling reason for that change.
But if the property that you're moving to is equal to or greater, they're more likely to.
They're much more likely, exactly, Casey. If the property I'm buying is equal to or greater in size and in price, it's not just price, size and price, much greater opportunity that we're going to be able to make that happen.
Do they do any kind of double checking on that, and 6 months later
No.
your house still isn't
My
listed?
next question.
No. Do we do follow-up on it? Not typically. Where they'll do follow-up on it is if that home goes into what they call first payment default. If that home goes into default, then you can bet they are going to check to see who committed fraud. And if my name shows up at the loan officer, I'm in big doo-doo. So I ask a lot of questions. And that means sometimes I turn people away and let them go to another loan officer.
Would that technically be fraud if they never
Yes.
got their house?
Yeah. Oh, that definitely.
Not technically.
Absolutely.
It is.
It is fraud. It is fraud. All right. So the first underwrite is AUS. We do that typically twice. We do it at the time of pre-approval. Garbage in, garbage out. Make sure that the lender is verifying everything. Looking at the documents. Looking at the pay stubs. Lenders say, well, I don't have to look at the pay stub. It's all automated. Talk to Rocket Mortgage. Yes, Rocket Mortgage. We all do the same thing, but when they'll do something called day one certainty, which means it automatically takes the information off of from the employer and automatically plugs it in. Now it's all accurate. Great. We all do that. I'd rather put my eyeballs on it because my name's going to be on this. And if I screw Casey up because his buyer now loses his earnest money, Casey's not going to refer me any business. I'm not taking that chance. And are you willing to take that chance with the lender? So garbage in, garbage out on the initial AUS. Let's make sure it's right. Second time we use AUS is when the loan is actually, we get a binding contract, we now update everything. That's when we find out if we're going to get a PIW, appraisal waiver. Once all that's done, the loan goes to operations, it moves straight over to underwriting for what we call the initial underwrite. And next week, Monday, we'll discuss we'll discuss number 3 underwrite and number 4 underwrite. Questions? All right, everybody, thanks.